Good morning, good afternoon, good evening, and welcome, depending where you are on the planet. And welcome to today's Monday, the 10th of October, Bull versus Bear webinar with Steve Miley on the call for Trade Day. Welcome, everyone. We're going to go for a usual regular run through in here today. But first of all, I just want to say I had a COVID booster jab yesterday, my fourth jab. Old man. So I am not feeling great. I've had a bit of a reaction to it. So the webinar is going to be relatively condensed today. We'll still run through everything we need to, but I'm not going to go into loads of details on the levels. The levels are in the technical analysis pack. You can go to the report. I'll do a brief look at some maybe closer levels. But as I say, I had this COVID jab yesterday and I'm not feeling great. So I've done very little this morning apart from feel rough. So I'll get through the webinar and then but a little bit condensed today. Let's take a look at the look back and look forward though, to give us the setup for the week. On the data front, actually, beginning of the week was fairly positive last week. Obviously, it was a tale of two halves for last week. You know, the first 2 days of the year, the month of the quarter, we actually had the S&P was up 5.6%, and it posted its best 2-day advance since 2020, and the third best start to an October since 1930. So, a really positive beginning to the week, partly driven by US ISM data, which we had at the beginning of the week, which was below expectations on the so that's kind of showing a slowing of the economy, a slowing of expectations, but also showed falling price pressures, which is good regarding inflation, right? So it's showing that the economy is slowing and the prices are falling. So that kind of puts into risk on move. And then the other thing we had was that US jobs openings, the JOLT report. And that saw data for August fell to its lowest level in more than a year, and it fell by the most in nearly 2.5 years, and it was more than expected. So again, we spoke about the labour market still being very tight, and so overall in here, a very positive start to the week. And then the third thing that drove us higher at the beginning of last week was the RBA. Do you remember the RBA? Reserve Bank of Australia, they hiked rates by only 0.25% rather than a consensus of 0.5%. And then that all added into this risk on rally, and that came on Tuesday. So, kind of data moving in the right direction, showing a slowdown in manufacturing, a slowdown and a slight tightening of the jobs market. A loosening of the jobs market, and then also the RBA. All of that pointing to potentially a slowing of price pressures, an easing of price pressures, an easing of inflation, and a gradual slowing of the economy, not the economy falling off a cliff. And then there was hopes then from the RBA that you might see the Fed pivot as well to a less hawkish tone, but the Fed speakers slapped that down through the middle of the week, and we stayed in a very kind of hawkish tone from the Fed. Then we had OPEC Plus. They announced a 2 million barrels a day cut at the upper end of market expectations. That drove oil significantly higher through last week. Massive rally in oil. Surged in the wake of the OPEC production cut, and coming from a multi-month low at the end of September. And then we saw the US employment report on Friday. 263,000 jobs added, kind of around consensus, not massively away from consensus. But the unemployment rate fell back down lower to match the 5-decade low at 3.5%, showing a still tight labour market. And that's a bit of a concern for the Fed, obviously. And then that helped with the risk-on move that we'd already seen Wednesday through Friday, then Wednesday through Thursday, then accelerated lower. So we kind of reversed, even though stocks kind of just eked out gains. So US stock averages was slightly up last week. European stocks and actually Asian stocks also posted decent weekly gains. They came back a long way from from the weekly highs. Gave up a lot of that early October gain. And then you also saw the dollar weaken and then it strengthened again. So you got the reverse happening. The dollar came down and then moved back higher. It actually closed the DXY, the dollar index, closed at a multi-decade peak on a weekly close. And then the pound having originally rebounded after the U-turn that we saw from the UK government on the tax cuts, then has faltered back lower. Gold rebounded higher, taking a multi-month low, as we spoke about oil surging, and then copper up with stocks and then back down with stocks as well, and still sets up quite negative. Key two things to watch going into this week: we get the Fed minutes on Wednesday, and then the key data is the US CPI. That's going to be massive, I think, coming straight after the Fed on Thursday. It is a Columbus Day holiday today, as you'll probably be aware of, for all our US traders. It's Columbus Day holiday today. Now, that doesn't mean stocks are closed. Stock market's open, futures market's open, but the US bond market is closed. So kind of definitely a lack of liquidity, maybe a bit more of a tempered day today, probably looking for less volatility today than you would see in a normal day. And then going into the rest of the week, we do have data from the rest of the planet. So we get UK employment Tuesday, UK GDP, manufacturing industrial production. US PPI doesn't really do much. That comes on Wednesday. Then we get those Fed minutes Wednesday. We also get German CPI ahead of US CPI on Thursday, and then Chinese CPI, and then US retail sales to end the week. So US retail sales and US CPI, the two pieces of data, and the Fed minutes on Wednesday. And expecting it's been a relatively calm start to the day. We have been in risk off mode in here. And if I go and take a look, let's just go look at the daily calendar. You see nothing of note coming out for the balance of the day today. We've had light data in Europe, and we've got nothing really significant coming through. And we do have, it's a Japanese holiday, I believe, as well as Thanksgiving in Canada. So, and what with the Columbus Day holiday, expecting things to be relatively quiet. So you see how stocks drop, bracing for earnings disappointment. So there's a lot of talk. We're into the beginning of October, so we will start looking at the earnings calendar, and I'll bring that in shortly. Actually, I'll bring that in now. Let's go take a look at the earnings calendar. So if we look at earnings for this week, so I'll share this. This is the earnings calendar I tend to look at from investing.com. So I'll put that that's in the chat. You see the chat there. And then what I do in here with the filters, so clearly we're looking for things that are going to affect the major indices. So I'm going to narrow it down to just have the US in here. And then I also narrow down to just have the ones with 3. So importance 1, 2, 3 stars. 3 stars obviously being the most important, because we're looking at the bigger large cap stocks that are going to impact into the markets, into the indices, right? So we kick off actually on Wednesday, PepsiCo, but it also kicks off with in earnest. Earnings season really starts in earnest with the financials. Sorry, I'm flagging a little bit here, guys. Not feeling great at all. So on Thursday, we get the financials. So we get BlackRock, well, that's it really on the financial side. We also get Walgreens, but you're looking at the bigger companies in here. It's not really till Friday we start this Friday. So on Friday we get United Health, but then on the financial side, JP Morgan, Wells Fargo, Morgan Stanley, Citigroup, PNC, and US Bancorp, and also First Republic. So a whole host, these top ones. This is sorted in market cap, so the bigger ones at the top by daily. So really it's when we kick off in here with JP Morgan, Wells Fargo, Morgan Stanley, that is, and then United Health as well. But these are the ones we're going to be watching, not until Friday though. There's a lot of chatter on both Bloomberg and on Reuters this morning as we go into the beginning of earnings season, the proper start to earnings season. A lot of concern around that. So let me go and actually what I haven't got here, which I haven't brought up yet. Actually, no, maybe I have 5 things. There it is, 5 things I did bring it up. So 5 things you need to start your day. What's impacting markets? It's a little difficult to tell whether this bridge. So basically, there's a bridge that connects Crimea, which the Russians annexed back in 2014. Okay. So they annexed Crimea, and there's a bridge between a really important bridge for supplies, linking Crimea to Russia, and that was attacked and seen as being done by Ukraine. And Putin is meeting his defense council, or whatever it is today. Using this as propaganda, calling it an act of terrorism, considering he's invaded their country, but he's calling it an act of terrorism. Anyhow, so we've had that has happened. Now we're in a risk off mode in here this morning. It's difficult to tell how much of that risk off mode is because of this development over the weekend, because it's heightened tensions. As a positive, obviously, for Ukraine. But then, what's the retaliation going to be? And there's a lot of concerns about that at the moment. And so it's heightened danger. So is the risk off theme, and we're definitely in risk off mode. Stocks in Europe are lower. Stock futures, the US stock futures are lower, and the US dollar is higher across the board in here this morning. So that shift to a risk off move, or not shift, that continuation of risk off move. Is it because of this? Or is it just a continuation? Because obviously Wednesday, Thursday, we saw a risk-off move. Stocks were lower, dollar up. And then on Friday, we saw an even a bigger acceleration post the employment report of risk off. So is it a continuation, or is it to do with this bridge blast and the destruction of this bridge? Or is it a bit of both? It's probably a bit of both, right? So, and it's not a massive continuation that we've seen in here this morning. The Bank of England started this week with stepped up measures to support the bond market, so increasing the size of its buying operations. This is what they stepped in and did, or announced they were going to do after the bond market collapsed to lower prices, higher yields, and the pound collapsed about 2-3 weeks ago now after they unveiled this tax cut. Obviously, they've U-turned on that, but market hasn't really completely recoiled. And so the Bank of England in today. What do we have? Earnings season. So a lot of people are looking at earnings season. Apple in particular, there's an article here on Apple. I can pop that in the chat as well. Stocks face brutal earnings season with all eyes on Apple. And I am sharing these out of Bloomberg. I have a subscription on Bloomberg. So if you haven't got a subscription, you're not going to be able to view some of these guys. You can always view 5 things, remember. And remember, you can get this in your inbox. Sign up. If I go back to the homepage, in here over on the right, you can get this every day. So go to bloomberg.com markets. I'll put that in the chat for any of you who haven't signed up yet. Bloomberg.com markets over here on the right hand side. You can get this delivered to your email on a daily basis. They do 3 versions: an Asian, European, and US version, and so it comes in your morning. So whenever your morning is, and it'll recap what's happened, basically since you went to bed, kind of stuff. Since the market in your area, in your geographical area, closed. So so there is a big focus in here on earnings season from both Reuters and Bloomberg as we go into earnings season, and a big deal being made about Apple as well. As a real reflection of the global consumer and the global economy. So all eyes on Apple. Banks including JP Morgan report this week, but investors focus on the iPhone market as a bellwether of global conditions, and we don't get that for a couple of weeks now, I think, until we get that. It's usually a couple of weeks in. So what else we have? Oil's actually dipped lower. We've gone into this. We've stayed in this risk off mode. Which and we had that spike higher in oil last week because of OPEC, but now concerns that the fact that we're looking for this global slowdown and that Chinese demand and potential global recessions will see less demand for fuel, and then so we've seen a dip. Well, that's the excuses the journalists are making. And stocks lower. Look, a Ukraine attacks and rate outlook spark flight to safe havens, but it hasn't been a massive flight. If we go and take a look at and one more article actually in here, dollars feeds on stress, and the dollar's up as well. But if we go and take a look at where we are this morning, take a look at the European exchanges. European bourses, you can see the FTSE UK index is down about 0.25%. The CAC's down 0.2, so it's not a big move. Actually, the DAX, the German index, is up 0.6 in here this morning. So it's not really been a huge move lower following Friday. And if we go take a look where we are on US, I see a big down move. S&P nearly 3%, Nasdaq over 3%, Dow over 2%. We're hardly anything. We've dipped. We've had a little bounce actually this morning, so we've hardly moved. We're down like a couple of tenths. Nasdaq's down 4 tenths. Sort of lower. So it's not a big continuation considering the extent of the losses that we saw last week. A quick nod to the Fed tool. So sitting up here now, but it's nailing on that we're going to get 75 at the next meeting. So that's it started moving back that way through the middle of last week, having got close to 50%, and it's pretty much stayed up there around that 70 to 80% level. So pretty much nailing on that move now. What else do I have in here for you? We've talked about earnings already. Let's take a look at the charts. I'm not going to go into detail here, guys. I'm just keeping it a bit briefer, but and all the levels are in the daily that you can get off the, get off the from the members area. But we have dipped and gone rebounded here. This is the S&P this morning, but you see the real big damage done by Thursday through Friday, particularly in Friday, that was a 5.6% rally, as we said. Best 2 days to start October since 1930, or the third best 2 days, and the best 2 days we've seen since March, back-to-back days, and then we basically wiped it out. Not all of it, but a big chunk of it. But the market having a little intraday bounce. I can only come into this negative. It is a bit of a dead cat bounce, you'd have to say, but it looks like it's making a small base. I wouldn't be surprised, as negative as I am, I wouldn't be surprised to see this pop higher before rolling lower. So I think there's kind of two trades going in today. I think there's a risk of a little bottom going in, recovering some of the sell-off that we saw on Friday, moving back up into 3670, 3680 level before the market moves lower. And the same for the Nasdaq in here. The Nasdaq actually got quite close this morning to last week's low. So the Nasdaq is certainly looking more negative. But again, in here, look, it's trying to put in a little bit of a base. Maybe a slight upside in here, but towards 11,150, 11,200, maybe even a little higher, but then looking for it to roll back down lower for there. So upside maybe slightly going into the open, and then looking lower. If we go and take a look at the quick nod to the commodity markets in here, gold stays very negative in here with the dollar strong. Go take a look at the dollar index. Where are we? Dollar index. This is on a 30-minute chart. If I switch it to the daily, so you can see the dollar's recovery continuing. Came through Wednesday, Thursday, higher Friday, up again this morning, looking very, very positive, and gold down with that. So gold just looks very negative for me and stays negative. Go to the 30-minute chart, intraday chart, but no recovery here, no bounce in gold. So that stays very much in risk off mode in here. It's kind of counterintuitive, but that's the way it's playing out at the moment. And I don't think this is a big deal on oil. We've had a correction, but look, 1, 2, 3, 4, 5 up days, okay, and a massive update on Friday. But if we do go into the 30-minute chart, as positive I am as like a swing trade, again, this is looking similar, like maybe a little top going in similar. It's like almost the upside down version of the stock indices. I wouldn't be surprised to see this lower and stocks higher. So maybe dipping back below $90, maybe towards $89 before it swings back higher again. Okay, so I think there's potentially two trades today. I think there's maybe a little risk off trade, maybe oil lower. Risk on trade, oil lower, and stocks higher, and then reversing that back around maybe later in the day, as I think the market's going to come in and just take any opportunity to sell strength in here on the stock side. Okay, that's my view anyway. All right, guys, I know it's a little bit light on the technicals today, but I say I am feeling dreadful after this vaccine yesterday. So I'm going to wrap it up there. I'm going to wish you all a great trading day. Keep an eye on the feed, guys. I am not available tomorrow. I'm not sure whether James is going to be able to cover tomorrow. So there may be no webinar tomorrow. I don't want you guys getting up and missing out. So keep an eye on the activity feed. Keep an eye on the heads up, the scrolling heads up that you get on the members area. If there's not going to be a webinar tomorrow, we will put that up there. We'll announce that in good time by around the close tonight. Okay, so do keep an eye on that, and so you know not to come on if there's not going to be one. I will definitely be back with you though on Wednesday. Have a good one, guys. Have a great trading day.